Good morning, everyone. Welcome to the trade findings and adjustments for September 25th. It is Friday. I had to move this one day. Next week, we are doing exactly the same thing. I am moving next Thursdays to Friday as well. It's only due to my scheduling. I apologize, but we're going to be moving the trade findings adjustments on Thursday out to Friday for next week, and then it'll go back to where it normally goes to. Very small group here today, no problem. We're going to get this posted so you guys can understand it, because as of recently, I've heard a couple of these comments. Kevin, the options aren't making up enough. Now, part of me wants to say, define enough, right? Isn't enough, how would I say it? Isn't enough maybe better than nothing at all if you didn't have options? If you're not making up the whole downward movement on a stock, isn't making something better than nothing? I do kind of giggle that, and I'm at fault at doing this too, so I'm not putting anyone down. I've been there. I'm looking at my option going, well, dang it, that's not making up anything on the way down. So it's a small group. There are only like 7 or 8, 9 of us here now. What do you tell yourself when you look at your option and it doesn't make up anything for the day? What is your thought process? Because typically what follows aren't making up enough. The option prices aren't moving today, or the option prices are wrong. There's a problem with the brokerage house, right? They're Robinhood who just make crap up all the time. Yes, I've got an example. In fact, none of you should ever invest in Robinhood. So what's your thought process? Kevin, when options aren't making enough, I feel like I've wasted my money. So when you're buying a protective put or a long put and they don't make anything on the way down, you feel like you're wasting your money. David, that is spot on. I mean, I guess what I'm going to say is that is 100% correct. That's the way I would feel. I'd be sitting there going, well, why the hell did I buy this protection, right? That's not making anything up on the way down. It does feel like a waste of money. And normally the last question is there. It comes down to, what the hell is going on? Why are these options broken? And I go through all 3 of those questions. So the first thing when you start working on something like this is to understand options. And understanding options is not easy whatsoever. How am I going to do this? I want to do this a couple different ways here. The components of the option price are right there. Those are the components. That's what makes up the price of your option. The underlying stock price, the strike or exercise price, which for all intents and purposes, those are fixed numbers, right? The volatility of stock returns, standard deviation of annual returns, the time to options expiration, which is always moving, the time value of money, the discount rate, which is always moving, and the payment of dividends, which is always moving. Well, Kevin, they either pay a dividend or they don't. Agreed. But if there is a dividend coming up or a perceived dividend in the near future, that starts to affect the option price. If you want to see what that looks like, if you want to figure out how to calculate that and why options sometimes get so difficult, there it is. There it is right there. And you're looking at it going, oh my heck. We have square roots divided by square roots. It's unbelievable. I love what's written down here, kind of a disclaimer. And I forgot who I got this through, but it probably is Robinhood for some reason. Remember, these quick and dirty calculations aren't 100% accurate, mainly because they assume. You know what assume stands for, right? ASS, you, me. They assume a normal distribution instead of a log normal distribution. They're merely handy in grasping the concept of implied volatility and getting a rough idea, or a theoretical idea would be a better word, of the potential range of stock prices at expiration. For a more accurate calculation of implied volatility is saying a stock might do, you use Alley Invested Probability Calculator. This tool will do the math for you using a normal, a log normal distribution. I'm going to go so far as to add one more piece to this. If this isn't complicated enough, the daily pricing movement on options is also based off of the Greeks. Can't spell there. When you look at the Greeks, I've got a cute little picture here. Come on, Greeks. The delta, the theta, the gamma, the vega, the RHO. When you go through the Greeks, when you go through any option pricing, you have to calculate these, and the only time that it is accurate is that exact moment that you calculate it, because they're ever moving, or they are variable movements. The delta represents the sensitivity of the options price to changes in the value of the underlying security. And the underlying security is always moving. Well, Kevin, at the close of the market, it's closed. Yes, and that's why options don't trade after hours. But after hours, guess what? The price of the stock is still moving. Theta decay is still moving as time keeps moving on. The gamma, the rate of change in the delta relative to the price change of the security, is changing as it's traded overseas in future contracts. Volatility is always changing. The only thing that pretty much stays the same is the RHO, but even interest rates are moving. The only time, and it's funny because we do this when we originally put on our trades, right? At least some people do. When you first put on your trade, you're looking at the delta, you're looking at theta, gamma, vega. You're trying to calculate where you're going to be profitable at. The only time that is accurate is at that moment you calculate it. The next day when you place that trade, guess what? It's no longer accurate. It's no longer correct. It no longer matters. The funny part of this is variable or theoretical data. Here you are trying to price a real return in options using theoretical data. Holy crap, what a joke that is, right? I want to base my real return on variable, ever-changing theoretical data. Would you scratch your head and say, oh my gosh, what's going on here? Now, some of you guys, as you've called in and been worried, what have I told you? What have I told you when we have a big down day and you're like, oh my gosh, it's not making up enough. It's not making up anything. What have I told you? Catching up. So correct. What I've told you is it looks like it may take a day or two for the option prices to catch up, which is why on certain days you might see the option price up, you might see the stock price up a nickel, and your option price for your long put, which should go down when the stock price goes up, is also up a nickel. Now we sometimes just say, hey, that's volatility. So it's funny because the volatility is okay if it's in your benefit, right? If it's in your benefit, oh, volatility is good, it's okay. My stock price is up for the day and my long put bearish moving option is also up for the day. That's okay. For some reason, we're like, yeah, that's the way it's supposed to be. That's 100% okay, right? When in real life, we know that should not be okay. If you're okay with that, you also should be okay and understand when it goes against you. But yeah, I mean, it's not okay. What's happening is the variable pricing is catching up. It's catching up. It's difficult. It's not quite 100% there. That's all that's happening, which is why, plain and simple, you should be trading with money that you can afford to lose. Wait a second. What did you just say? Investing, and it's a joke, let's face it. Investing by the big brokerage houses will tell you this should only be done with money you can afford to lose. Well, with all due respect, what they should be telling you is you should be investing with money that if you lost would not significantly affect your lifestyle. That's why they consider it gambling sometimes. Oh, trading the stock market is gambling. Not so. Not so. It's just done with, plain and simple, and if you ever done calculus, it's just done with some imaginary numbers, which kind of sucks. Imaginary numbers, it's weird, it's unusual. But there is such thing as imaginary numbers, and all it stands for is where numbers should be based on theoretical, uncertain computations because you don't know where it might actually be. You're trying to guess. So, plain and simple, when options are dragging behind you, you're frustrated. When you say, well, when I put the trade on and it should do this and it doesn't, it's because, plain and simple, all option pricing is done through variable theoretical data, and none of it is exact calculations except for the exact second you calculate the data and place the trade. That's it. You know how many times I get the question, Kevin, why isn't everyone doing this? And it's usually when we just made a crap ton, which is another finite, definitive, excellent comment to use in trading, right? It usually occurs when we made a crap ton of money on the way down. Or the same comment is made when people are just getting into Hurley investments. Why isn't everyone doing this? Because everyone can do it. There's not a broker out there that can't do exactly what Hurley Investments does. My comment is usually pretty simple. My comment is, well, with all due respect, people are stupid. The reason why other brokers don't do it are because people are stupid. They're okay with just setting their money there and letting it just go. They're okay with putting it into a fund and getting raped by the fees and charges that are out there. They're okay with not caring enough to look into what's happening. The worst part about it, they're okay with not understanding or not having to go through the frustration of dealing with imaginary numbers and theoretical data. The worst part about it, you've got educators out there that act like they've got it all figured out, that there's some secret sauce that they always predict and know exactly what's happening. I mean, it's a joke. Let's face it, it's a joke. And people buy into it. And again, I know some of you are probably getting a little pissed off right now at me. I've been there. I bought into it. I've made the mistake of spending way too much money on education. I pulled the trigger. I bought it. I bought into the story, and I didn't go through and find out what real life was. So a question was given to me, two questions actually. So yesterday, what should we put on for Costco? Earnings after hours. It's that simple. What should we do after hours? My comment was, well, I don't know. What I do know is I wouldn't put a directional, and I'm going to do a quote unquote on that one, right? I wouldn't put a directional trade, can't spell, on before an earnings event. It just doesn't make sense. That's gambling. It's a 50-50 that you'll understand which way they're going to go after earnings. And if you do know ahead of time, it's insider trading and it's illegal, right? So I would never put a directional trade on before earnings. Let me go ahead and put that a little different way. I would never put a directional trade on before earnings. That includes spreads, that includes leaps, that includes anything. Well, Kevin, a spread isn't directional. It's a bull put, a bull call, because it's bullish. Non-directional, strangle, straddle, protective put, collar trade. But usually putting a collar trade on just before earnings means you're spending a lot of money. It's already priced in. So I never put something on before earnings. Next question. What about a trade today? Now that they are down $9 roughly. So my answer there, put on a bearish trade, and at $328, look for a trend change. It's that simple. And again, I'm not doing anything ridiculously prophetic or what have you here. I'm just looking at Costco. They're trying to hold the 200 day or the 50 day, excuse me. If they break the 50 day, the next stop on the way down is right in here. $325, $328, there's a range there. It'll have to pass through a pivot point at $331. But we probably have another $9 to $14 to the downside. So that's your range. Your range is if Costco falls below the 50 day, it's going to have another $14 for you to put a trade on. If you wanted to be cheap, you go out of the money and you put on a 330, 325 bear put or bear call spread. You're playing to the level it might get down to. And you're exiting the trade at 330, not trying to get your full maximum profit with it going down to 325. If you wanted to bear put it, you could do a 345, 340 above a resistance level if it breaks that 50-day simple moving average. All you're doing is just looking at a chart and deciding where those points are that you can make money on portions of the wave. It's that simple. For me, because it has not broken, I wouldn't be placing a trade today. It's something I'm going to look at on Monday. If you do place a trade today, again, you're trying to outguess the market. Will or will it not hold the 50-day simple moving average? Right now, it's holding it. The last hour may tell us otherwise. Just some things to think of there. So understanding options is going to be very important for people before they go and they place a trade ever. And if you don't understand options and the theoretical pricing, don't ever expect to get a finite return. That's why you hear Hurley Investments and Keeve and I and Jeffrey talk a lot about spreads, about ranges. we don't get to specific dollar figures. Well, Kevin, you nailed it on Apple. Well, no, I took some data from FinViz, and somewhere between 480 and 503 would most likely be the stopping point as people got all excited about a 4-for-1 split and you saw the valuation push to the highest end. It was kind of a lucky guess. A lucky guess using theoretical data to give me a general idea where the stock price might go. I nailed it. Let's face it, I nailed it. I nailed it right to the dollar almost on where Apple was going to stop. But it was taking that theoretical data, and I gave myself a range of $23, 480 to 503. That was my range that I had for Apple. If I looked at Costco, I would be very interested in getting in to some leaps right around here. They actually had some very good earnings, very good same store sales, at least here in the United States. Their downfall is internationally. International, they dropped 1%, but they made it up here in the US. So, plain and simple, great company, but today I would not be looking at putting some type of I wouldn't be looking at putting some type of weird, ridiculous trade on. It's just not a good setup. And that's the interesting part, right? The interesting part is do you have to place a trade every day? Because in all honesty, whatever foolish rules are made up, you're going to have to break them in some way, shape, or form to justify putting on a trade when it's a bad time to put a trade on, when there isn't a good setup, when the probabilities are not going to be in your favor. That's why I'm not a fan of education. Anytime you see an education, I'm going to give you a trade a week. Your host. They've got to put you into crap with some bad setups because they've got to give you a trade a week. Oh, I've got a 100% return. Really, show me the account and show me all the trades. Be willing. If you hear that, be willing to say, hey, bring it up. Show it to me. Well, I can't do that. Yeah, you can't do it because you're full of crap. Not every day is the same, but in a zero return market, we're up over 10%. A $440,000 account's up 531 for Coda investment. That is real. It is shown to you. Real returns. Come on, play catch up. There we go. A $12 million account up $1.37 million. It's a real account. Real people, real money. A $10,600,000 account up 1.2 million. I'm not in education. I don't do trades each week. If I was saying, hey, that's what I do, you guys should say, open it up. Show me the trading history. Let me see if money's been taken out. You know how I make this return really good? I take out or lose 6.6 million. One of the 401ks, I lose that. My year to market gain still stays the same, but I've got less money there. All of a sudden, I've got a 20% account. There's so many easy ways to fix the system. Simple things you should always be paying attention to. Guys, have a great weekend. All I'm trying to do today is help answer and teach you a little bit about understanding options. Abraham, I will definitely check that out. And are there any questions here today? William, I know you're kind of new. Any questions you guys have today that I can answer for you? So yes, we're in a waiting game. Right now, we're in a waiting game to see what happens in the election, to get ready for earnings. That is what we are doing right now. We are in that waiting game. So we wait. We wait or we try to outguess the market. The choice is 100% yours. But for me, I trade the market. This is real money. This is not paper money. This is a job for me. My own money is in here. I choose not to outguess the market. I'm just going to be smart. Smart and patient. Guys, have a great day. Appreciate you being here. Look forward to seeing you Monday night. Next Thursday, trade finance adjustments, usually at 10 a.m. Mountain Standard Time, is also going to be pushed to Friday, 10 o'clock Mountain Standard Time. Guys, have a great day. Enjoy your weekend. I'll talk to you next week. Bye-bye.